All right, so if we compare Tesla to big tech, a lot of these big tech companies attract similar types of investors and therefore compete for the same money, investment money. So where are people going to put their money? Is it going to be in big tech, Apple, Microsoft, Facebook, Meta, companies like that? At the end of the day, they're all competing with each other. They're kind of in a similar industry, whereas Tesla is something entirely different. Chinese auto companies. I see a scenario where its domestic players will repeat the success story of Japanese manufacturers in the 1980s. The most promising Tesla challengers are battery companies. It is not a surprise that BYD is shaping up to be the most credible challenger. And I agree with this. I think that the biggest threat to Tesla and everyone else is Chinese automakers, because they're making great cars that are almost as good as the Teslas. So I think if you're going to pick what is the biggest threat to Tesla, that's it. It's the Chinese automakers. Nobody else is a threat to Tesla right now. So Tesla, if we look at their projected EPS for 2022, it's $4.12. And then if we just compare all these different companies, so the ones that are expensive based on the consensus estimates are above the blue line. The ones that are cheap based on consensus estimates are below the blue line. Tesla's below the blue line. Enphase is above the blue line. Funny enough, I have been thinking about Enphase lately and how overvalued it was, and I figured it was due for a correction. But a month ago, I was thinking about going short Enphase. I didn't end up going through with it, but it's down 30% in the past month. It was due for a correction, definitely, and it's still overvalued, as you can see here. So taking all the above together, I believe Tesla should and will run based on a 50 to 60 times current PE going forward. It may overshoot, it may undershoot at times, but I consider that to be the baseline. Here is why. Tesla aims to grow its top line revenue by more than 50% per year for a long time. This is not just management's wet dream. It is actually underpinned by actions, most importantly, battery scaling plans. Okay, they've already shown they can do it. They've been doing it, and there's just more reason why they can grow 50% as we see the batteries that they're producing now and the energy storage. The bottom line should grow at least as fast as the top line. Based on the broad market comp set, 50% comes with a suggested multiple of 55x. Based on the more narrow Tesla peer group, the suggested multiple is 62x. So if we just look at the estimates here, so 2023, the consensus estimate is $5.48, 5.48 times 62. Tesla stock could be trading at $339 at the end of 2023 if things go well. And again, I can't stress this enough. If this market melts down, all this goes out the window. But I like this because it's just giving me an idea of what is the fair value for Tesla? And you know what? We want to be conservative. Let's assign them half that PE ratio, and it's still got 50% upside with a 30 PE ratio, basically where it trades right now. So Tesla grows 50% again next year, still brings in the same PE ratio, will be utterly ludicrous. It's still got 50% upside from where it currently trades. So if Tesla traded on 50x 2022 EPS of $4 today, it would be $200 a share. And if it grew that EPS by 50% annually, they'd be at $13.50 EPS in 2025. They would by then trade at a 15x multiple, which would effectively constitute the end of the growth story. Even if markets don't buy the 20 million vehicles per year scenario, I think there's at least 3 years visibility to the Tesla growth story. So Tesla could, by 2025, be bringing in $13.50 of EPS. We compare that to BYD based on 2022 EPS. BYD trades at a 39x multiple, a 35% premium to Tesla. But Tesla is the one that should be trading at the premium to BYD, right? There's a few reasons for this. BYD is a Chinese company. There's a whole lot less transparency over in China, a whole lot more political risk. You never know, you never truly know what you're investing in with these Chinese companies. That's been my experience so far because they just don't have the same accountability standards as we do in the US. Tesla has proprietary FSD technology. BYD does not. They are using Baidu's technology. Okay, limited. Tesla is more profitable and therefore less vulnerable. Based on the last 12 months, BYD is currently at a 3% operating margin. Tesla's at a 16% operating margin. So again, when the going gets tough, who's going to have a bigger problem? BYD, who's barely making money as is, or Tesla, who can lower the prices and still bring in a profit? Tesla has much higher brand value. We talked all about that. And a lot of their vehicles, they look great. They have great specs, but they also feel like a Model 3 copy. So there's another thing. I've noticed a lot of these EVs look like Tesla copycats, and that's fine. You copy who's the best person. YouTubers do it, and that's fine. But I just think you can only get so far copying others. Why would someone buy a Tesla copycat? It's like a Wish copycat version when you could buy a real Tesla. And again, we go back to, we put the full picture together, the brand value. Why do people buy iPhones over a smartphone that costs a quarter of the price but they still stick with the iPhone. I think what's going to happen is the same with Tesla. BYD has very little exposure to the US battery story. Tesla is the biggest beneficiary of the IRA of any company out there. Tesla has zero internal combustion engine exposure. Any IP associated with that will become worthless by the end of this decade. So the two biggest technological megatrends relate to batteries and AI. Tesla provides you exposure to both, which is quite scarce and should come with a valuation premium. Think of their FSD program, what you want, and discount it as overhyped driver assist. Tesla is the only company currently running a large-scale hands-on project to liberate AI from cyberspace and bring it to real space. Even if we don't see robotaxis for a long time, there's a lot of commercialization potential with very near-term EPS impact. For example, take rate for the $15,000 FSD beta package may increase significantly after its wide release. They just went to wide release November 24. So again, what I see is a company that still has a lot of upside just based on the electric vehicles they sell. You're getting a free call option on if these things were to succeed. You are getting them for free if you were to invest today. Full self-driving, Tesla bot, Cybertruck, semi-truck, energy storage, solar panels. I can go on and on. Real world artificial intelligence. So to finish it up here, let's look at some potential share prices based on the current EPS. So we know for, right now, Tesla's EPS should be somewhere around $3.50. If you give them a 40 times multiple, you get around the current stock price of $120. If we were in a better market and they had a 70 times multiple, it'd be at $210. Now, if we go out, next year, the EPS the consensus estimate is $5.50. So somewhere between $5 and $6 here. And with a PE of 40x, just at $5 of earnings, the stock is basically a double. And if the market wants to assign it a higher multiple, the stock could run to $350. So we've got a wide range here, but all this chart tells me is that buying Tesla today, you're paying a decent price for the future. Over the next year, anything could happen. The stock could drop 50%. But if Tesla continues to execute and grow on average 50%, hell, even if they grow only 30% and they keep doing it year after year, which so far they have the last couple of years, 60% one year, 40% the next year. I see no reason why they can't grow in the ballpark of 50% a year. So, here's the potential multiples the market can assign to that. But what I see are a lot of numbers that are higher than what the current stock price is. And that's all I need to know. If you enjoyed the video, please don't forget to like and subscribe. If you want to read this full article, check it out. Written by Fallacy Alarm over on Substack. I'll link that down below. Let me know what you think in the comments below. This is Vinny from the Investment Club, and I'll see you next time.